The United States military struck Iran again on June the 9th, 2026. Radar sites, air defense installations, Keshem Island, Jask, Sirik, Bandar Abbas, all targeted within 4 hours of each other after a U.S. Apache helicopter went down near the Strait of Hormuz. Iran responded by firing ballistic missiles at U.S. facilities in Bahrain, Jordan, and Kuwait simultaneously. The ceasefire that was supposed to hold is now debris, and silver is sitting at $64.32 as of this Wednesday morning, June the 10th, with Monday's market open, less than 72 hours away. Most investors watching this are doing the same mental calculation. War escalates, oil spikes, inflation rises, safe haven demand flows into gold and silver. Silver goes up Monday. That calculation is not just incomplete, it is the exact calculation that cost the most money in the most recent documented example of exactly this scenario. Here is what actually happens to silver when the U.S. strikes Iran over a weekend. Here is the documented pattern from 3 separate Monday opens in this conflict cycle. And here's the specific financial framework you need in your hands before Monday morning, because the 2 most important things happening simultaneously, the ongoing Iran escalation and Kevin Warsh's Federal Reserve debut at the June the 16th and 17th FOMC meeting, are pointing in opposite directions for silver, and understanding which force wins the open is worth more than any price target any analyst publishes before the weekend. Let us start with the data that most retail silver investors have not internalized. February the 28th. 2026 was a Saturday night into Sunday. The United States and Israel launched nearly 900 strikes over 12 hours, killing Iran's supreme leader Ayatollah Ali Khamenei, destroying his compound, eliminating more than 40 senior Iranian officials, and triggering the immediate closure of the Strait of Hormuz. Every checkbox you would need to see for a massive safe haven rally in silver was checked simultaneously. Geopolitical maximum shock, energy disruption, Middle East war risk at levels unseen since 1973, and gold already in a bull market above $4,000. What happened to silver at Monday's open? Silver jumped 2.8% to $96.40. The safe haven buyers showed up as expected. And then, within hours of that open, silver collapsed more than 6% toward $88. Not Friday close, not Sunday night. Within the same Monday session. By Monday's close, silver was lower than it had been on the preceding Friday. The single most dramatic geopolitical event in the Middle East since the Gulf War produced a Monday net loss for silver. And the mechanism that produced that loss tells you everything you need to know about how to position before this coming Monday. The mechanism was documented in real time by multiple market analysts in the hours after the open. The US dollar surged simultaneously with the safe haven silver demand. The dollar surges in risk-off environments because every global financial transaction denominated in dollars creates a demand for dollars when crisis hits. That dollar surge mechanically compresses silver prices in dollar terms, because silver is priced in dollars, and every dollar that the dollar index gains is approximately a corresponding percentage compression in silver's nominal price. The ISM Manufacturing Prices Index published that same Monday morning leaped to 70.5, an 11.5-point jump that was described by every economist covering the data as signaling reignited inflation and instantly slashed the probability of any Federal Reserve rate cuts in 2026. Higher inflation expectations plus rate hike fears means tighter monetary conditions, means stronger dollar, means weaker silver. All of that happened in the same session where Iran's supreme leader was killed and the Strait of Hormuz closed. The safe haven bid was real. It was overwhelmed by the dollar bid and the rate shock. The safe haven bid took silver to $96.40. The rate shock took it back to $88 in the same session. The second documented data point is June the 8th, 2026, the Monday 3 days ago. Iran and Israel exchanged their worst strike since the ceasefire began on April the 8th. Iran fired 24 ballistic missiles at Israel. Israel struck Tehran, Isfahan, and Tabriz air defense systems. Iran struck Beirut. Both sides fired energy infrastructure. The ceasefire collapsed. And silver's Monday open came in down 1.8% from Friday's close. Not up. Down. This is the market's assessment of the escalation. Iran escalating means higher oil. Higher oil means higher inflation. Higher inflation means the Federal Reserve of Kevin Warsh must stay tighter for longer. Tighter for longer means higher dollar. Higher dollar means lower silver. The war premium that most retail investors assume exists for silver actually works against silver in the first 48 to 72 hours of every new escalation event because of this specific rate dollar transmission mechanism. The third data point completes the pattern and reveals the trade. March the 23rd, 2026, was the session where silver had plunged towards $61, its lowest level since mid-December, in the worst single-session liquidation event of the entire conflict cycle. The cause was the same, surging oil prices from the Hormuz closure, hawkish central bank signals, and the ISM price jump that came with February's hot inflation data. Then, on that same March 23rd, Trump announced a 5-day pause in planned strikes on Iranian energy infrastructure, citing productive conversations with Tehran. Silver immediately reversed from $61 and rebounded above $70 in the same session. A 23-month high liquidation reversed into a double-digit percentage recovery in 24 hours. The trigger, not a military development, a diplomatic one, not a strike, a pause. The implication is precise. The single most powerful bullish catalyst for silver in this conflict cycle is not an escalation. It is any credible signal that de-escalation is occurring, because de-escalation means lower oil, lower inflation pressure, less Fed tightening pressure, weaker dollar, and the safe haven premium gets to reassert without the dollar headwind overriding it. This is the core financial framework for silver before Monday's open. The question is not whether the U.S. struck Iran again. It did. The question is, what happens to the Fed's rate path as a result of the specific way it struck Iran and the specific way Iran responded? Here is the current state of those inputs precisely. The strikes on June the 9th targeted Iranian radar and air defense sites at Keshem Island, Sirik, Jask, and Bandar Abbas. These are surveillance degradation strikes, not energy infrastructure strikes. Iran's oil export capacity was not directly reduced by the June 9th strikes. Iran's ability to track vessels and guide future drone attacks was reduced. This distinction matters enormously for silver because the oil inflation rate transmission only activates when the oil supply is directly threatened. Destroying a radar site at Keshem Island does not remove barrels of oil from global supply. It removes Iran's ability to track which ships are in the strait. The direct oil supply impact of the June 9th strikes is close to zero. The Hormuz closure that has been partially in effect since February the 28th is still the dominant oil supply variable, and the June 9th strikes do not change its status in either direction. Brent crude was above $96 on June the 9th. It remains elevated, but not acutely spiking from the latest round of strikes. Now layer on the CPI data that was released this Wednesday morning. Consensus expected headline CPI at 4.2% year over year for May, up from 3.8% in April. If the actual print came in at or above 4.2, the rate hike fear narrative that has been crushing silver since the blowout May jobs report on June the 5th is confirmed and intensified. If it came in below 4%, a genuine surprise to the downside, the rate cut narrative revives and the dollar weakens, which is the most bullish short-term silver catalyst available right now. The timing of the CPI print relative to Monday's Iran escalation creates a specific compound effect. A hot CPI plus ongoing Iran escalation equals dollar strength squared. Rate hike fears from domestic inflation, adding to the geopolitical dollar safe haven bid simultaneously. A cool CPI plus ongoing Iran escalation equals a split signal where the dollar is weakened by reduced rate hike expectations, while the geopolitical premium tries to add back to silver. The cool CPI scenario is the one where the safe haven bid actually lands, and silver can hold the $64 level going into the weekend. Here is the most important variable of all for Monday's open that is not being discussed loudly enough in the mainstream silver analysis. Kevin Warsh takes the chair at the Federal Open Market Committee for the first time at the June the 16th and 17th meeting. That meeting is 7 days from today's Wednesday. Every piece of data released between now and June the 16th, including today's CPI, including whatever Iran does over the weekend, including the next set of inflation expectations from the University of Michigan survey, releasing Friday, is going into Kevin Warsh's decision brief for his debut policy statement. Warsh is a documented hawk. He dissented in favor of earlier tightening during the QE era at the Fed. He has specifically noted that the Fed may have overinsured against downside labor market risks given the May jobs data. The market is currently pricing above 70% probability of at least one hike in 2026, up from zero probability just 2 months ago. If the Iran escalation over the weekend produces a visible oil price spike above $105 that Warsh must address, his debut statement will almost certainly contain language about inflationary risks from energy prices that the market will interpret as hawkish. Hawkish Warsh debut plus continued Iran escalation equals the worst short-term combination for silver at $64. Hawkish Warsh debut plus ceasefire emerging over the weekend equals a mixed signal that produces volatile silver around the 64 to 68 range. 3 specific things to watch between now and Sunday night that will tell you with high confidence which direction silver opens Monday. First, does the U.S. strike any Iranian energy infrastructure over the weekend? The June 9th strikes hit radar, not energy. The April 5th through 6th strikes hit South Pars petrochemical and triggered the near ceasefire. If any weekend strikes target Iranian oil production, refining, or export infrastructure, Brent crude will spike above 105 when Asian markets open Sunday night, and silver's initial Monday open will be higher. But watch whether it holds above the open for more than 4 hours, because the February 28th precedent says it will not unless the dollar simultaneously weakens, which requires a specific trigger discussed below. Second, does any ceasefire signal emerge from Oman, Qatar, or Pakistan channels before Sunday night? The most bullish silver scenario before Monday is a credible ceasefire signal from the Omani or Qatari mediation channel on Saturday or Sunday. The March 23rd data shows that ceasefire news is worth 23% upside in silver from these levels within 24 hours. If Oman's foreign minister posts anything constructive on social media, watch silver futures immediately. Third, watch the University of Michigan Consumer Sentiment and Inflation Expectations Survey releasing on Friday. This survey's 1-year and 5-year inflation expectation components are the specific data that the Federal Reserve uses to assess whether inflation expectations are becoming unanchored. If the 1-year expectation rises above 5% in Friday's release, Warsh has even more justification for a hawkish debut. If it is flat or declining, the rate hike fear narrative softens heading into Monday's open. Now here is the honest silver framework that combines all of this analysis into a specific financial position before Monday. Silver at $64 is in a genuinely ambiguous zone. The March 23rd low was $61. The December 2025 breakout level that launched the bull market is $59.34. The bull market's structural thesis, 6 consecutive supply deficits, industrial demand from solar and AI, negative real interest rates, is intact at $64. The tactical thesis for buying into Monday is contested because of 3 simultaneous headwinds. Rate hike fears from hot CPI, ongoing Iran escalation that paradoxically raises dollar demand, and the psychological proximity to the March $61 swing low that is making physical buyers cautious about catching a falling knife. The tactical thesis for selling into Monday is also contested because the supply deficit is real. Physical demand at 474 metric tons in Q1 was the second highest quarter on record. And every institutional analyst from the most bearish to the most bullish has a year-end target above the current price. The specific position that is defensible before Monday, given all of these variables, is a scaled entry with a defined stop. At $64, the stop that makes technical sense is a close below $59.34, the December launch pad. The reward target from here is $80 by year-end, the most bearish institutional forecast available. $4.7 of downside risk to the stop versus $15.7 of upside to the most conservative institutional target. That is a risk-reward ratio of approximately 3.3 to 1. Not because silver is going to 61 or 59, but because if it does, you have a defined exit that respects the actual technical structure. The most important thing to understand about the U.S. striking Iran again and what it means for silver before Monday's open is not the price target. It is the transmission mechanism. Every Iran escalation event in this conflict cycle has followed the same pattern. Initial safe haven spike. Dollar surge and rate shock overpower the spike. Silver gives back the open gains and often closes lower than pre-escalation levels. Then, when diplomatic signals emerge, silver reclaims the lost ground in a single session. The trade that has worked every time in this cycle is not buying the escalation spike. It is buying the diplomatic signal dip. The escalation creates the dip. The diplomacy creates the recovery. Silver at $64 on the Wednesday before a Monday open that follows U.S. strikes on Iran on Tuesday and Wednesday is, by the documented pattern of this conflict cycle, the dip that the diplomatic signal eventually recovers. The question for Monday specifically is whether the diplomatic signal comes before the open, giving you the recovery, or after the open, giving you a dip to add to first. Trump said Iran has 21 to 22% of its missiles remaining. That statement, delivered publicly from Air Force One on June the 5th, is a signal that the administration is managing the public narrative toward an endgame. A regime with 21 to 22% of its missiles cannot sustain indefinite military pressure. A regime that is massacring its own citizens across 31 provinces cannot sustain indefinite internal pressure. The nuclear deal, talks that Iran's foreign ministry described as being in a chaotic state on June the 8th, are chaotic but not dead. When they become not chaotic, silver moves 23% in a single session, as it did on March the 23rd. The setup before Monday's open is not asking you to predict when the deal happens. It is asking you to be positioned for the session when it does, with a risk budget calibrated to the 44-month low nearby, and a reward target anchored in the documented second half of 2026. Recovery thesis that every institutional analyst, from the most cautious to the most aggressive, is describing as inevitable. The U.S. struck Iran again. Here is what it means for silver before Monday's open. In the next 72 hours, if more strikes happen and oil spikes above 105, silver opens higher and gives back the gains by midday as the dollar and rate shock overpower the safe haven bid. If any credible diplomatic signal emerges from Oman or Pakistan before Sunday night, silver gaps higher from 64 and does not give it back because the removal of the rate shock headwind allows the physical demand to set the price. If nothing changes and the current fragile pause holds through the weekend, silver drifts into Monday between 62 and 65, with the entire focus shifting to Warsh's Wednesday statement and whether he validates or challenges the 70+% rate hike probability that is currently the single most powerful force against silver's recovery. In every scenario, the structural bull market case is intact. The supply deficit is real. The industrial demand is growing. The monetary conditions remain net negative in real terms. The trade before Monday is not predicting which scenario happens. It is being positioned for the signal that marks the transition between them. Subscribe, because I am tracking every Iran development with same-day analysis connected directly to silver's price action and telling you what the military moves mean for the market before Monday's open every week this conflict continues. Watch the next video because the specific question of what Kevin Warsh says at his debut FOMC on June the 16th and 17th and what that language means for silver's second half trajectory is the most important monetary policy event for precious metals investors in 2026 and the framework you need before it arrives.